Dividend received from an Indian company was exempt until 31st March 2020. It was taxable, but in the excess of rupees 10 lakh for an individual. However, the Finance Act 2020 changed this with effect from 1 April 2020, and it is now taxable in the hands of the shareholder. Now the provision has changed and the companies have to deduct TDS at the rate of 10% if the dividend paid by them to the individual investors is more than 5,000 rupees in a financial year. And a 2.5% relief was available during the COVID period with effect from 14 May 2020 until 31st March 2021. The tax deducted will be available as a credit from total tax liabilities. For example, if your dividend income is 6,000 during the COVID period, the TDS deductible would be rupees for 50 rupees at the rate of 7.5%. For non-resident persons, TDS is deductible at the rate of 20% subject to DTAA, and they have to submit documentary proof in Form 10F, and if the documentary proof is not submitted, higher TDS would be deducted. Deduction of expenses from dividend income. The Finance Act 2020 also provides for interest expense deduction up to 20% of the dividend income. If your income is 6,000 rupees from dividend and your interest expense is 2,700, then your total interest deduction would be 1,200 rupees subject to 20% of the dividend received. Advance tax on dividend income, that is, advance tax is applicable if the individual's total tax liability is greater than or equal to 10,000 rupees in a particular financial year. Dividend from a foreign company is also taxable. It is included in the total income of the taxpayer under the head IOS, and it is charged according to the slab rates. If you come in the 30% slab rate, you will have to pay 30% tax on the dividend along with cess. And 20% interest deduction is also available for dividend received from foreign company.